this week's Financial Flash. This week we're going to take a little detour and use the time together to make sure we're all on the same page when it comes to terminology. We frequently use common financial terms in our videos and meetings, and it occurred to us that perhaps not everyone is clear on the exact meaning. So today I'd like to take time to clarify 5 concepts that every investor should understand: market timing, alpha, risk, liquidity, and diversification. Let's begin with market timing. Many people believe successful investing is about knowing exactly when to buy and when to sell. The reality is that market timing is the attempt to predict short-term market movements in order to avoid declines or capture gains. While it sounds appealing, consistently doing so has proven extraordinarily difficult, even for professional investors. Missing just a handful of the market's strongest days can significantly reduce long-term returns. Rather than trying to predict what the market will do next week or next month, successful investing is more often about having a disciplined strategy and sticking with it through changing market conditions. Next is alpha. Alpha is often confused with high returns, but that's not quite right. As we've discussed in prior videos, alpha is the return an investment manager generates above what would be expected given the amount of risk taken, relative to an appropriate benchmark. In other words, alpha is commonly used as a measure of investment skill. If 2 portfolios each earn the same return, but one achieved that return while taking less risk, that portfolio generated positive alpha. High returns alone don't necessarily mean a manager has added value. Now let's talk about risk. Most investors define risk as losing money, but in finance, risk is better defined as uncertainty about future outcomes. That uncertainty includes the possibility of gains as well as losses. For long-term investors, one of the greatest risks isn't short-term market volatility, it's failing to earn enough return to meet future financial goals. Understanding risk means recognizing both the potential rewards and the potential setbacks that come with investing. The 4th term, liquidity, refers to how easily an investment can be bought or sold at a price close to its fair market value. Highly liquid investments, such as U.S. Treasury securities or large publicly traded stocks, typically have many willing buyers and sellers. As a result, they can usually be traded quickly and with very small bid-ask spreads. The difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. That narrow spread keeps transaction costs low. Less liquid investments, on the other hand, may take longer to sell and often have much wider bid-ask spreads, meaning an investor may have to accept a lower price to complete a sale quickly. Private businesses, commercial real estate, and certain thinly traded securities are common examples. Liquidity doesn't tell us whether an investment is good or bad. It simply describes how efficiently it can be converted into cash without sacrificing significant value. Finally, there's diversification. Diversification isn't about owning a large number of investments. It's about owning investments that respond differently to economic conditions. A portfolio made up of 50 technology stocks isn't truly diversified because they're influenced by many of the same factors. Effective diversification combines assets whose returns are driven by different risks, helping reduce the impact that any single investment or market event can have on the overall portfolio. These 5 terms, market timing, alpha, risk, liquidity, and diversification, are more than financial jargon. They are common concepts that shape every investment decision. Understanding what they really mean helps investors avoid common misconceptions, make more informed decisions, and stay focused on achieving their long-term financial goals instead of reacting to short-term market headlines. Financial terminology shouldn't be a barrier. If you hear a term that doesn't make sense in a meeting, a video, or anywhere else, ask. We'd rather clarify than have you wondering. Understanding your strategy is the foundation of confidence in your financial plan. Have a great weekend, and we'll see you in the next Financial Flash.
Educational content by the professionals at Styles Financial Services, delivering customized portfolios aligned to your unique wealth goals.